Bring that ass back like a boom, 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 boom.
Hey guys, welcome to Boom Traders. This is Supernova, and today's video is risk versus reward. Now I'm doing two videos, this one and another one coming shortly after it, because there are certain differences between stocks, futures, crypto, forex, and options. So this video right here, I'll be talking about defining risk versus reward when you're trading stocks, futures, crypto, and forex. And the reason why I'm doing it like this is because options do offer an additional layer of risk definition that some of you might find interesting, but I really think we need to talk in depth about it. So let's just stick to stocks, futures, crypto, and forex in their normal way. What I mean by normal way, there are options on stocks, there are options on futures, and there are options on crypto. But I'm just talking about right now trading stocks, futures, crypto, and forex as they are, not their options. So risk, and that's point number one here, risk is the amount of money that you're willing to risk in order to see whether your thesis is right or wrong. There's nothing more to it, there's nothing less to it. It's the cost of doing business. Accept it. There is absolutely no way of you trading without occurring losses. None. If you think that you're going to be stuck and the path is going to be up, 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 well, you are in for a very rude awakening. Most traders, especially breakout traders like myself, we lose more times than we win. And you'll be thinking now, what? What? Well, yes. I gain money from the trades that are working, and this is what risk versus reward means. When I'm trading, I'm defining my risk in one or two ways: by technical setup or by amount of money as percentage of my account equity that I can lose. I'll show you what I mean in a second, so don't worry if you don't understand what I'm talking about. Risk can be defined in two ways. As I said, I'm a breakout trader. So when I trade breakouts, there are certain support zones below the breakout or below the base that the breakout is coming from that you can use as support zones. In terms of mathematics, there is a rule that I don't break. So let's start with this rule. No loss can be more than 1% of my account equity. So, to speak in terms of money, if I have $100,000 in my account, so the account size is $100,000, the maximum loss on a trade can be no more than $1,000, which is 1%. That means that if I'm trading a position that is 25% of my account size, so $25,000, like I wrote here in the example, I can afford a 4% stop loss, because 4% from $25,000 is $1,000, or 1% of my account equity, which is the maximum allowed to use. This is where everything starts from. You have to, for yourself, define this. Now, general guidelines are you don't want to go above 1.5% of your account on a single trade. And when you're trading larger accounts, $10 million and above, you are probably looking for half a percentage on your trades, no more than that. So, now that we know how much we can risk on a single trade, our account equity, and with a technical setup, we will be defining the percentage of a stop that is okay in terms of the setup. We will extrapolate the amount of shares that we can trade. So let's look at the chart. This is Alcoa, AA, and this is one of the recent gainers in such a turbulent market. So if you're trading breakouts, let me just draw two lines here, two zones. You see that you probably have a pretty good size base, and this is a daily chart, by the way. Each bar, each candle in this case, it's 1 day. So you have a pretty good base. If you switch to the weekly, you'll see that you have a base that's a bit, it's not the perfect base to say so, but it's a base nevertheless. So let's look again at there. So you have a base that is confined in this within this range, and it's been tried to be shaken out. So weak hands are being let's say taken out of the market with this large bar and large volume, and we're breaking the recent range. So everybody's like, whoa, we are going down, right? Well, guess what? Next day, it's a very small inside day, another day with a long wick to the downside. So you know what's going on. Like everybody that shorted here is thinking, well, what? There's no conviction to the downside. But everybody who's been long in this range is already out, because this candle effectively broke the range and closed below it. So everybody covered their shorts. If they had, well, everybody got out of their longs if they were long here, because this is a breakout to the downside. Then we have a 4 candle that is basically going back into the zone. And if you draw support, let me just see. If you drew support right here, you will see that this next candle just closes right about here, and we have a gap up. So we're basically gapping up all those support lines that we can draw here. We're just gapping over them. And this was support, this became resistance. We went back in, we gapped over. On the next day, we have an absolute monster of a day, almost 100% bullish candle. This support, well, this gap here is not filled. So you can trade that. And if you traded this, you have to place your stop loss below the low of the prior day. This is what technicals do. But in case you are a little bit more conservative, you can place your stop loss right here, below the low of the recent swing low. So if you do that, let's measure it and see what is our stop loss. So let's say you're trading this candle right here, and you are placing your stop loss right here. Now, as you can see, this is 12.75%. Right, so your stop loss would have to be 12.75%. Now, from the get-go, I'll tell you, I cannot trade this. Why? Because if I'm placing my stop loss at 12.75% and I'm expecting 5 times the reward to my risk, that means that I'll be looking at about 60% to the upside in order to make a gain, which for me isn't reasonable to expect. Right, so I'll be looking for a place where I can place the stop loss in about 2, 4, absolute maximum is 5%. So I'll probably, in this case, I'll be trading right here at the low, and the low on this candle is 46.73. So I'll be placing my stop loss at 46.73. So I'll be looking at 46.73. And this is about right. So this is about 4.47%. Right, so if I place my stop loss right here, and let me just draw a line so you can see what I mean. We said 46.73, just about right. So let me just blow it up. So it's right here. So I'm trading this close right here, placing the stop loss below this low right here, and I'm expecting 5 to 1. This is almost 5%. Let's just pull it. This is 5. And let's just see where we made 25%. So right above here, this is 25%. So we made 25, we risked this amount to make this amount. You see this happened in 1, 2, 3, this didn't hit our stop loss. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 days, half a month. So in half a month, we got 5 to 1. Now, not everything works so perfectly. Don't get me wrong, not everything works so perfectly. So, bad things happen. But when you are defining your stop loss in such a way that you're risking $1 in order to make $5, even when things are not working, you are safe. On the other hand, I've seen people, they will tell you, well, I'm right 80% of the time, and I do 2 to 1. Fine. Okay. But being right 80% of the time is an outlier. Most traders don't even make it to 50% of the time. Remember that. Most traders don't even make it to 50% of the time. What happens then? Well, what happens when you have a really bad streak and you're down to 20, 25% of the time, right? You have a streak of 5 losers. This is where your account starts to suffer. So aim for a higher risk to reward. 5 to 1 to me is perfect. 4 to 1 is okay, it's on the lower side. And if you can make it more than 5 to 1, that is absolute beast. Because remember, in bad markets like we have right now, your batting average or your success rate will suffer. So as we said, right here, if we trade this candle right here, the close of this candle, and we put the stop loss below the low of the prior candle, we're looking at about 5% stop loss. As we said, we already know that we can risk a maximum of $1,000 on my account. That means with a 5% stop, I need to understand what amount of money I need to trade. And it's really easy. 5% of $20,000, it's $1,000. So I know from the get-go that if this is my stop loss, and as I said, I trade at the end of the day, so I have time to make the calculations. It's not a complicated job. I can trade about $20,000 of AA shares, which at this price means that I can trade about 300 shares. A little bit less than that, but I'm just talking in general right now. I'm not using calculator. I'm not being absolutely precise about that. And usually when I'm trading, I'm not being absolutely precise about that either. I just try to fit into general parameters. So this is how I define my stop loss. Now, if we look at something else, let's just look at a recent trade that I did was on Zim, and I've been in and out and in and out and in and out of this, and you can see I have a lot of levels right here. So a recent trade that I did was I traded off this triangle right here. So okay, let's just do that because it's fairly easy to understand. So we had a pretty substantial move to the upside. So we moved like 20% in about 5 days. Then we consolidated for 5 more days. And then I just traded the breakout of those zones. So I traded the close, as I said. I traded the close and I placed the stop at the low of the previous day. So that's 7%. I trade a small size. That's fine. I know that if I have to place my stop loss on 7%, which is right here, I need to trade less size. So that's a fairly simple computation. I just see 7% of what amount of money is $1,000, and I go by that. So I trade, and my 5 to 1 need to be about 35%. Let me just tell you, I didn't make it, but I'll show you where I closed because I wasn't really happy with what was happening. So 35% would have been, well, higher than that. I closed on the gap down of this candle. Why? I just didn't like the way this looked. So this is a 2 to 1 trade. Still okay, but not nearly as good as I want it to be. But when I see a gap down after such a day, which is a hammer, well, it's shooting star and all these Japanese candlesticks. I will link a pretty interesting book by Steve Nison in the description of the video, so you can check it out. I don't like this gap down. This is a reversal pattern right here after a big uptrend. This is a reversal candle right here. This is a very long wick to the upside, so I don't really like this gap down. I closed it. I should have waited. Yes, the market was in a turbulent zone. Remember, that was last week. That was last year, July, August, July, September. So market was in a turbulent zone, and though it's been in a turbulent zone for quite some time now. But anyway, I probably saw something in the general market, but I don't like this gap down. And believe me, I only keep about 4 to 6 positions at a time. If I had like 20 positions, there's just no chance that I can monitor them so closely, each one of them. So anyway, I closed it. This is one that I traded. Recently, ZIM has been on my radar again. I traded off this little breakout here. I got stopped out right here because I traded this candle. My stop was right here at 8%. This time I did not close it because I was only at 1 to 1, so there's absolutely no point closing it, and I got stopped out on this. As you can see, it happens very often. The next day, after this big wick, which took me off, we closed positive. Next day, see what happens the next day, which is really, we gapped down and we fell almost the entire candle. On the next day, we gapped up over this line. You see, I drew this trend line so I can trade the breakout of that trend line here. On the very next day, we gap up above this trend line. Now I'm in. My stop loss right here is the bottom of this candle, because this was too wide and this was below this line that we already gapped in. So I was afraid that we might gap down. That's why I traded this before the end of the day. I traded about 10 o'clock in the evening, and was seeing that if we do get a move, well, 10 o'clock for me, but actually it's 1 hour before the market closes. So I was thinking, if this moves down and took me out, then it's a very small risk. Next day we get a gap up again and another gap up, and I'm like, all right, that's fine. I moved the stop loss to where I entered and I just let it there. But anyway, my risk was 1%, and I made, with this trade, I closed it, no, not here, I think I closed it on this trade right here. So it was like 20 to 1. It's just insane. But this is a stock that I've been keeping a very close eye on, and I don't usually post those high risk plays because, you know, not everybody is fine just risking 1%, because you can be taken out in seconds, really seconds. But this is how I go about defining risk to reward. There is an easy formula that will give you a lot of insight. The average win, and for that you need to keep a track of the percentages of your wins. So for example, it doesn't really matter if you keep the percentages as like you're risking $100,000 and you made 5%, or your risk is 1% and you made 20 times this. It doesn't really matter. I keep my statistics clean in terms, I put the size that I traded in, which in this case was less than $20,000, because I wasn't really sure in the setup. But anyway, I keep the amount of stocks that I traded, the price that I got in, and then the price that I got out. And then this computates a percentage of gain. So definitely I got in at the price here at the bottom was about $60. I got it at $60. I went out at about $70. So I made the gain from 60 to 70, which is not 20x. But my stop loss was only 1%. So I could have only lost about 50 cents in order to make $10. You see where I'm going with this. But the average win times the percentage of winners divided by the average loss times the percentage of losers. And the percentage winners, percentage losers is very simple. You keep track of, like, you have 10 trades, 7 are winners, 3 are losers. That means 70% winners, 30% losers. 100 trades, 35 winners, 65 losers. That's 35% winners, 65% losers. For this, I don't do it on an Excel sheet, although you could. You can check the spreadsheets in Boom Traders. We keep this pretty open, the trades that we talk about in our private offices there. For this, I use Edgewonk. Now, Edgewonk is a platform let me just show you what I mean. Edge1 is a platform that does that for you online. It's paid. I don't have a promo code, I'm sorry. I pay for it just as everybody else. They can do some pretty fancy stuff, and you know, trade simulator like shows you how your account equity will grow or fall. It's not always like that. You can do trading plans. You can do I don't think that they speak about it here. Oh yeah, you can see it right here, screenshots. Yeah, you can what I really like, you can upload screenshots of your trades, the setups and so forth like that, and then you start. After that, there's like a chart book, and then you go and look at different charts of what you're trading or what you're not trading, where you put your stop loss and whatnot. It's really an interesting, thing, but it really does a lot. Yeah, it just, I like it. I really like it. It's, I think it's like 180 per year. Let me just check. Light done available. Yeah, I know. Yeah, okay. So $169 per year. So you get everything. There's no free. Yeah, it's been discontinued. Anyway, I don't really think it's a lot. And as you see here in my ultimate combo, I wrote it like setup is important. I really encourage you guys to master a single setup. You don't want to be trading like crazy different setups and like bottom fishing and like top reversals and like support and resistance breakout through the 50 squeezes. You want one setup that you will master. That's what you want. Master this one setup, you'll be more than happy and you'll be set for life. Do the math. Never exceed this 1 to 1.5% loss on your account equity. Never exceed it. Please guys, I urge you to be careful. The capital that you have in your account is what is making you trade. I mean, if you don't have capital, you cannot trade. So capital preservation is goal number one. Gains will come, but you need to be focused, proper setups, master them, know what to expect from your setups. As one of the greatest traders of our time, Mark Minervini, said in one of his books, if you know what the setup is and you know what to expect, you will know if something is wrong with the setup. Why? Well, it becomes second nature. If you're waiting on a train station and the train is supposed to arrive at noon, 12:05, and it's 12:10, and it's not arriving, you know something is wrong. Now it might be something that is little wrong, and it's okay, but if it's already 1 hour past, 2 hours, you know that the train might not be coming. So you better get out of this, train station. Go find another transportation. Go look for alternative roads. But don't get on this train. Something's wrong with the train. So know your setup, do the math, and last but not least, the journal. Keep a journal. I know many people are underestimating the importance of journal, but keep a journal. It's vital to your success as a trader. Thank you guys. I hope you liked what you saw. If you do have some questions, I'm in the chat room pretty much all day. Do chat, do ask questions, and let's make money. See you guys soon. Thank you. Bye-bye.